Welcome to the NISM Masterclass. I am your host, Sashi Krishnan. As part of our purpose at NISM, which is capacity building for the securities market ecosystem, we sit down with the gurus of the securities market to gain from their insights. And my guest today is Nipa Sheth. And Nipa is the director and founder of the Trust Group, which is a full-service financial services house. And she is all this. The Trust Group is also a leader in the Indian bond market. And I think Nipa has over 25 years experience in the bond markets in India. And in her career, she has won many awards, especially as the best bond house in India. And I think she's also currently the chairperson of the National Council for Corporate Bonds Markets in ASSOCEP. So welcome to this show, Nipa. And let me start off with asking you, a very fundamental question. Why is it important to have a vibrant and well-developed corporate bond market? For the last 3-4 decades, we've been talking about, the importance of a vibrant corporate bond market in India. And how does a corporate bond market help channelize capital and household savings into, the productive sectors of the economy?
Okay, so first of all, thank you, Shashi, to have me here. I think it's really a privilege to be part of this. And of course, bond market has been a long journey. And as you know that, Trust Group has successfully seen the almost the 3 decades today in terms of how the bond markets are changing, right from physical format to demat formats and lot of volumes. However, I think there's a long road to go. As you mentioned that, when we are looking at any country which is looking at development, and, all of us are looking at maybe a Viksit Bharat by 2047, and if not 2047, maybe a few years later. When we are going through this entire development, it is very important to have country to our physical infrastructure and also the other infrastructure by which you create jobs, you create, fundamental comfort for the individuals. And therefore, however important is the equity and the capital market, debt market plays a very, very important role. Right. Because in that terms of growth, that productive money which goes for savings and building of infrastructure is very important. Right. And debt market plays an extremely important role in this segment. So, and as we have the corporate and the household saving, which gets channelized into different parts, which could be equity, gold, real estate, I think then becomes a significantly important part. And especially now, when we are having real interest rates, it does protect people against inflation, has a very safe saving. At the same time, we can have the country's infrastructure building up.
So, Nipa, let me take you on two of those issues. One is the volume, and second is the need for capital. So if you look at the total outstanding issuances, most definitely they have been rising. So, 10 years back, they were around 17.5 lakh crores. Today, they're something like about 53.6 lakh crores. Right. So there's been a huge amount of capital that's being raised from the debt markets through the corporate debt. But if you look at it as a percentage of GDP, it's around 15% of GDP. And clearly, most countries that have seen rapid development, this is a much larger number. Like the second thing is that, these numbers seem to suggest that we're seeing a gradual shift towards market-based financing against traditionally what was, bank financing, which was used for most of the capital, debt capital that was needed to drive the economy. Do you see a stage where, market-based financing becomes as big as, say, bank credit in India?
Yeah, so some very important data point. Today we see the bank credit at around 350 to 320 lakh crore.
Right.
Out of that, I think the retail loans would be around 160-65
Right.
or a BBS. So that means the corporate loan from the banking sector is around 55 to 60 lakh crore.
Oh.
Which is similar to the corporate bond market. I'm taking the government debt and the state government debt out of this.
Right.
So which is similar. Now, slowly and steadily, over the last 5 years, the incremental corporate borrowing from the market space is more than borrowing from the banking sector.
Is that so today?
It is that today. I mean, if you see last 2-3 years, the actual corporates borrowing from the debt market has been slightly more than the banking, and therefore now we have come to a number because banks also in general have focused a lot towards retail lending in last few years.
Right.
And we have come to an equation where both the numbers are almost same. From here, we definitely see that the more and more corporates will come to the bond market because the rates are flexible. There are different instruments, maturity wise. You can have your ALM mismatch. So we definitely see that changing. If you see the leverage of corporate, I think it is multi-decade low. We have come with a high of around 1.5 to 2.5, which was in 2015, today to almost less than 1 time leverage. So all corporates and financials are today sitting with very, very strong balance sheets. Most of the balance sheets have been cleaned up. And I think you are at a stage where you can take off into a higher leverage game. And the debt capital market is allowing that option at least to the primary issuers to probably have all of this. So we very clearly see that more and more corporate and infrastructure projects, which are already operational, more municipals, more state government bodies will come to corporate bond market for a big size coming from here. And today you become equal. And I totally agree with you that India is at 15%, China is at 150%. So, if I have to compare the number, the bond market should go 10 times from here. But even if we don't go anywhere nearby, I think we are at a stage where our infrastructure and manufacturing boom, we are hoping, is just taking off. And therefore, a vibrant debt market will become a need of an hour, whether it's a merger and acquisitions, whether it is infrastructure, which is done, and operational roles which can come into the major pipeline, going to be very, very important.
So that is a very interesting insight, saying that if you sort of strip away the retail lending that banks do, today the market-based financing through corporate bonds is almost the same as bank credit to industry. Uh, but another question is that who is this credit available to? At least the market-based financing, because today what happens is AAA bonds, almost dominate the entire issuances that we see in the corporate bond market. And firms that are AA rated and less, I think, are less than 15% of the total issuances today. And if you compare this to markets like the US or Europe, close to 90% of the issuances are A rated and below, right? So, two questions I had out there. From a demand side, why is there this preference for higher rated bonds and very limited demand for lower rated bonds? But as important, from the issuer side, is it that lower rated issuers avoid the bond market and prefer bank loans because bank loans are more flexible in today's context, and they require fewer disclosures, which I think becomes more difficult for lower rated companies?
See, I think this entire question has few parts to it. First, I will come from the bond market investor. The bond market is dominated by institutional investor. The first being, banks, insurance company, provident and pension funds, mutual funds, other institutions, and retail and individual. Out of the total number, I don't think more than 90% is institutional driven. Less than 10%, maybe close to 5% will be individual driven. Most of them are also governed by their internal guidelines, as pensions or insurance, where you have a deep understanding.
Things they can invest in.
They are all only into AA and above. Even mutual funds, to a very great extent of the schemes, is also AA and above. Hence, their ability to invest in less than AA is very minimal. If you see the rating profile of the entire rated universe, you will be close to 25,000-26,000 crore. More than 50% would be less than BB. So more than 12,000 companies would be less than BB. And also, if you see the upper end, there will be only 1,500 companies which will be AA and above. So obviously that universe is small. However, the acceptance in a big market for less than AA is very rare because everybody is restricted. Oh, I cannot buy below AA, though you have conviction in the company. So that takes away. However, slowly and steadily,
that 15% space of non-AAA has become almost 30% plus. We are also seeing that private credit, AIF, foreign institutions have come into a higher yielding segment, which is maybe 15 to 18%. And we have seen significant size even in a triple B bond. I mean, we've seen a single bond issuance of 18,000, 20,000 crores. So that has changed the market. The second piece, what we saw earlier, is that the bank lending to less than AA entity, the spread which they charge is much lesser than what bond market used to charge. So if a A minus company will go to bank, they will charge 100 bips over AAA, whereas a bond market may charge you 350 bips over AAA.
So bank credit is actually cheaper than.
Cheaper for them. It is not just the disclosure; it is also the pure, cost of funding. And I think as we see more individuals coming to the market, as we see more openness, we see lesser rated issuers, number of issuance going up, and also the yields going down on that segment. At least the NBFCs have been able to access that market well.
Okay. So, similarly, uh, because institutional investors dominate this space, most of the issuances have been private placements, right? In fact, if you look at the last year, almost 9 lakh crores of private placements took place. Just about 2% of the total bond issuances were in the public space. And that's primarily because of the issue that it is institutional investors who dominate this space. So how do we, you know, encourage corporates to, move also into the public space?
See, there are two, three issues here. One, the process is much longer. So, you go through a process of approval with, MCA and all of that, as against a private placement that once the resolution is done, rating is in place, it's a 1 week process, as against a much longer process. Disclosure level, to my mind, SEBI now almost has similar disclosure and compliance. The issue is time to the market and expense. Because when I go through a public issue route, a distribution does take away a significant chunk of the entire distribution fees. And therefore, any rate sensitive corporate would be more not very willing unless, one is looking at a compulsion of development of a market and which can reach out to more people. That is the reason we see lesser issuance, only the issuer. I mean, significantly, the people who will go to the public issue market will be NBFC, who are looking at a different, it's a raw material for them. So they would want different channels to be giving them money, and therefore retail is important for them, not only from a rate perspective, but a blended, source of credit. So over a period of time, we have seen one or two PSUs coming in the market for a public issue, or otherwise it is, generally, public NBFCs who are looking at a differential resources. For most of other guys, institutional money is very simple to take and much easier to take, and the process also is very fairly transparent and well defined by SEBI. So I think that is the reason.
So you still think that going forward also it will be primarily the NBFCs who will be accessing the public markets, and the non-NBFCs, manufacturing companies, would continue to prefer the privately placed.
At least in a near term, I definitely see 2 to 3 years, unless we see the change of how issuance happen. Can I give access to more investor in a public private placement kind of environment?
Right. So you were talking about the demand side. I just had a question out there that there are not too many instruments available to manage risk in the ecosystem today. So if you have a corporate bond portfolio and you needed to hedge interest rates, or you needed to go in for an instrument like a swap or a credit derivative, those instruments are just not available out there, which is one of the reasons why a lot of people feel a gap in the in constructing a portfolio. So if somebody needed to hedge interest rate risks or hedge credit risks in India, how would that institutional investor go about doing that?
See, the issue is the depth on any of these instruments. So we've seen regulators, SEBI, Finance Ministry, as well as RBI. Everybody has tried their best to bring out some of these instruments, whether we talk about a credit default instrument, whether we talk about interest rate futures. So there is a framework. However, fortunately, unfortunately, the restrictions, because again, it's an institutional led market, everybody also have to have their own internal guidelines to do this. Some of them do require a significant amount of capital for them to do those activities. And I think somewhere a full access to every market participant is missing in some of the action. So what happens is, when I come as an individual or I come as a corporate house, my need is higher than the institutional need, because I want to hedge it because I'm new, I don't understand full risk, whereas the access is slightly limited. And even institutions have their internal guidelines to be done. Though I think in recent times a lot of new changes have come in, and I think in couple of years we will see these taking off in a very different manner.
So you talk about capital being a constraint. So just a thought that occurred to me is that, say banks and other lenders, they can free up a lot of capital from their balance sheets, lower their financing costs, etc., by securitization, right? And, we've had mortgage-backed securities, asset-backed securities in the market for a very, very long time, but that's sort of product that has, sort of taken off, and not too many people have used that route to free up capital to do a lot of other things. Uh, and even yesterday, if I remember, the regulator has come out with, sort of harmonizing the entire securitization process with what, the RBI has, by allowing single asset securitization. So a lot of work is being done in terms of the framework. But how do you see securitized assets taking off? Because this can free up a lot of capital for more productive purposes, isn't it?
For sure. However, look at two fundamental things. One is the real estate affordability in the country. Though we are moving towards a very high real estate prices, if you see people at affordable housing range, the number of people who can afford real estate are still not many. So the mortgage boom as we would want to have, it is not there. So I am growing almost at the size at which I can expand my balance sheet. So if you see your non-food credit today is anywhere between 13 to 15%, which is equivalent to my deposit ratio. So I do not have a compulsion to free up my capital. So unless I see that, that is the first part, that I need a capital need to do this, for which we need a far higher growth on the fundamental mortgage lending, which I think, again, there is a lot of effort on affordable housing, SOPs, but as it happens, we will see the results happening there. Second, of course, harmonizing of the, guidelines need to be done. And as you can see over the last 3-4 years, there is a lot of discussion between SEBI and RBI to ensure that there is a smooth path for this. But if you ask me today, if any of the lenders, do they really want to,
Do they need that capital?
do they need that capital? You see in last 1 year, a lot of gold, lending companies will come to do securitization because they were growing at a rate which was not sustainable with the kind of
They didn't have
resource
enough
they could
capital
raise.
to sustain
They
that
were
growth.
they were growing at a more than 50%. So they had to do that. Whereas I think mortgage will need that fundamental piece to do that. But I think we've again got some pieces right in terms of how do I actually take that market to the credit market. We've seen mutual funds participating. We've seen some of the bigger housing company, which now got aligned with the bank, has done some sizable issues on that, and there is a good acceptance.
So you do see that market, having a future in.
Absolutely. Market has an infrastructure which is there to do it. I think at the right time of growth, people will start looking at it very closely.
So let me shift to the secondary market, because you did say that a little while back when we were chatting that secondary market liquidity is something that we seriously need to pay attention to. And I mean, I think we all admit that the secondary market for corporate bonds is still very shallow in India. And the average daily volume, even though it's increased over the last couple of years, will be 5,000, 6,000 crores, not more than that. And again, as you said, I mean, it's mainly institutional investors, and these institutional investors are in, AAA rated securities. So again, the entire secondary market is in those AAA rated securities. So, and secondly, if it's institutional investors, they have a buy and hold strategy. So most of these people, the pension funds will buy it and then, forget about it till maturity. So what needs to be done to improve secondary market liquidity? Because unless we have more secondary market liquidity, things like price discovery, etc., become, aren't very efficient.
Absolutely. So, we run a country which has probably one of the most efficient equity market systems. Debt is different because debt, of course, unlike an equity, which is one reliance and one script, one reliance paper can have 20 different bonds issuance with different terms. However, I think the most important part was to get the information correct, and I think kudos to SEBI for what they've done over 3 years in terms of transparency, in terms of understanding the information of any new issuance which has come. So I think over the last 5 years, at least whosoever has issued, at least everything in terms of covenant and everything is covered and is publicly seen. Second, in terms of how many people can access to the market. And I think that's a fundamental issue which needs to get corrected. Today, you go to equity markets, you trade on exchange. Okay. Whether you are an individual, whether you are an HNI, company, institution, everybody goes on one thing. In debt market, though the settlements happen over there, you need not go through the same channel, whether it's a broker or it's a exchange. I feel having a common platform which is accessible to all. We have a very institutional approach to the whole thing. Slowly, we are keeping the retail part, but what we are, probably missing out is the HNI and corporates who can also play a very important role. And for them to see, we've come with an RFQ system where people can see the rates, but a seamless settlement system along with, rates which people can see will make a big difference on how a secondary market.
So you're saying trading infrastructure and settlement infrastructure need to be standardized and uniform.
It can be, it is standardized and uniform. I think excess of that standardized and uniform system for corporates and individuals will be very important because they are generally the people who come on the other side of the market when there are, tight turns like a pension. Second, I also feel the liquidity against these instruments. Today, an individual or other people will move towards either bank or liquid fund to bond market when I know either I can sell or I can get some funding against that. And I think liquidity becomes a father of every market, as you say. And the moment we solve it, we have tried to do this for repo. We have got MC repo for a higher rated instrument, but again, access is limited to regulated entities. So I think once that changes, it just changes the entire product portfolio and market participants.
So taking on this theme of liquidity, I think one of the biggest drivers of liquidity in any market are the market makers, correct? And there are almost no market makers available in the corporate bond market in India today. In fact, even if they are available, first of all, they're not capitalized. They don't have enough capital to take the kind of risk. If all of the entities in India are very happy to take on the role of arrangers, but nobody is happy to take on the role of a market maker. So why do you think that has happened, and what needs to be done to get more market making happening in this corporate bond market?
Uh, See, one, if you see the arrangers, there are some bank led arrangers, there are some PDs, and there are merchant bankers, three categories. So, if I see the banks, I think banks' focus has moved on to retail and retail lending, and they've become very sizable to be doing either a broking or a DCM market making activity. From an overall perspective, very few banks would be interested in probably, engaging in that activity. PDs, I think primary focus remain the rate driven, government security. It leaves with a very small set of arrangers. And some of those arrangers may not be an active secondary market participant as well, except for that book. So I think there is a scope. There is a scope for many more intermediaries to come. The moment you have the entire ecosystem going through intermediaries and through exchange, a lot more well capitalized intermediaries will come into this market. Today, they are absent. It obviously has advantage for few players because you can be market leaders.
Exactly.
But I know that there is a very clearly a space for more intermediaries to put a big market. Just give you an example that today every financial product penetration we are talking about now in 10 crore, 20 crore, 30 crore, whether we are talking about demat account, equity holders, mutual fund holders, at least till the end of last year, I would say there were not more than 5-6 lakhs bond holders in the country.
That's
So,
including
the
institutional, retail, everything.
even with the rise of OBPP platform or retail materialization, of course, it's moving fast. But I don't think we are still talking about more than 0.75% of total demat holders having bond. So there is a long way to go, and there is a lot of piece which can move here.
So talking about the trading infrastructure and the settlement infrastructure, this request for quote mechanisms, RFQ mechanism, which SEBI brought in, I think in 2020, it was primarily brought in with the objective of shifting the corporate bond trading, from what was traditionally the over-the-counter market into an electronic trading. So that was the attempt, right? So how has this initiative actually impacted bond trading? Because from whatever I heard you say, there is still some way to go in terms of electronic trading and having a platform for bond trading.
So it's definitely changed from where we were. There are people who would put quotes. SEBI has ensured that people actually use RFQ for quotation, but again, access is very important. We are giving access to now. Of course, individuals can get access if they are, registered through OBPP, but that's a small set of numbers. So we see RFQ. There are two modules there: one to many, one to one. We still see a little more one to one, but I think any platform, an RFQ can be probably ultimately widely distributed where everything is, information is given to larger audience at large will work well. And I think that's a effort towards that, which I think can work well.
So you've been talking about the OBPP platform, and it has been partially successful in making the bond markets accessible to retail investors. In fact, there is something in the papers today which says that the OBPP platform providers may extend their services to IFSCA, the gift city also. So we're making it accessible to retail investors. But I had a slightly different question, saying that accessibility is one thing, but the retail investor also needs to be aware of what exactly he or she is getting into when he or she is investing into a bond. So just by providing an OBPP platform, will we be solving this problem for retail investors?
At least it's a great beginning. And I think from the beginning, SEBI has looked at it very well in terms of ensuring that the information available to the retail investor, it's in best practice. So, they did start looking at this because given the number was very small and can become very large, I think there are regulations which came in.
So if I may interrupt you, if you get onto the OBPP platform and you want to get some information on a particular bond, that is available on the platform to the investor? Or does he need to go somewhere else to find that information?
So there are members of OBPP. So, and all of them will have their own sites. And when you go to those sites, there are formats in which you have to give the information. So first of all, they can do only listed bonds. So that itself is very big because when you can do listed bonds, a lot of information is available. So the rating and the rationale and all of that is, and yield, all of them is actually displayed. They definitely have to deal through RFQ. So there is a good amount of transparency in terms of settlement, in terms of what they're getting into. But of course, at the end of it, there are credit risk, but credit rating rationale is available. So it's a well displayed information outlet in that model.
Okay. And they can access that information from each of the OBPP providers and then go onto the platform to trade. So
No, OBPP is an association of the traders or fixed income who has an online presence on this. So this is like a MFI. Okay. And the members of MFI, as they have mutual funds, there are members of OBPP who will have their different terminals. And you can.
and all of them are required to give standardized disclosure.
Yeah, there are disclosures which has been set by SEBI that you have to go with those.
Fair enough. So access becomes easier. It is still up to the retail investor to go and
And each of them will have a different product. Because it is, unlike an equity markets, as I told you, the offerings and the settlements happen through a different system. So, A OBPP and 2 OBPP can have completely different bonds. They both may be listed, but everything is not available on all platforms at all point of time.
So there are several other regulatory changes that SEBI has introduced over the last couple of years, including they have sort of limited issuers could have a maximum of, I think, 14 ISINs maturing in any single financial year, in trying to reduce the complication, making choice much simpler for people. Similarly, I think listing fees for debt securities has been reduced. They have introduced optional liquidity window mechanism. They've set up the AMC Repo Clearing Corporation. So, which of these have made a significant impact on? I mean, all of them have made an impact on the bond market, but which do you think are the ones that have made a significant impact on bond markets as a whole?
So, I think overall together, it's a significant impact. You've done EBP, you've done a listing guidelines, you reduced the fees, you made a lot of standardization. From a primary perspective, it's become a great engine. Okay, a lot of corporates, for them to issue, it's become simple, it's easier. The bigger corporates do not even have to do a lot of things. PFC can just upload issue and go to the entire market.
So you have a single document which now can be used for.
Absolutely. Repo platform is great as a platform. However, I genuinely feel that a liquidity depth in a secondary market can make a big change for number of more people to come in. AMC repo is, of course, restricted to regulated entities, which is there as per RBI guidelines. I think the moment today the banks may not want to borrow against the bonds. But as an individual or as a company, I may want to borrow. I think the moment we bring that, those participants will rush to come in. Otherwise, bank deposit is an easy way out. I might get 2% less, but I can get my money whenever I want. So that piece, if that changes, I think will bring any form of liquidity, whether it's repo or I think will make a big change to the debt market.
So you were mentioning RBI also sort of bringing about a lot of changes in their approach to the corporate bond market. In fact, RBI now insists that large corporates at least raise at least 25% of their incremental borrowing through the corporate bond market. Has that led to larger issuances happening in the corporate bond?
It has. It has. You've seen bigger corporates accessing the market seamlessly, and I think a lot of companies who would not otherwise think of bond market as an option has started thinking.
So most of these large corporates would go to the bank for their working capital requirements and would come for all their capital requirements to the corporate bond market. Is that how they structure their borrowings?
No, I think at least the AAA, AA plus and above, I think probably also look at fixed floating tenure they're looking at. But they are coming with a lot of ease in the markets. Even for the mergers and acquisitions, it's a route which is preferred because banks typically did not, so far till the last policy has changed, were not allowed to lend against mergers and acquisitions. So that also became a very big part of the entire bond borrowing program.
Okay, so a lot of it is also for these acquisitions and those kind of programs that they sort of run. Systemic risk has always been something that's been sort of worrying, at least investors in the bond market. We've seen incidents in the past that have caused, this kind of an anxiety. And I think as a response to those incidents, the central government set up this corporate debt market development fund and the guarantee scheme for corporate debt. Do you see that as sort of helping mitigate this extreme volatility in bond markets, or giving people a sense of comfort that systemic risk is now would technically be under control if at all such situations arose again?
So, thankfully or otherwise, post the setting up of the fund or post the situation, we have seen a very different run and we haven't seen the need to do that. But yes, they can effectively work as a market maker where liquidity is a compulsion. We have to understand a significant part, which is of, this industry also works in a T+1 guidelines. And therefore, it can be any time, but liquidity becomes, and they do not have the access to the banking lines like an RBI lines. So repo plus this fund can be very useful in times. we are hoping that,
This reduce anxiety levels.
it reduces anxiety levels here.
Okay, because we tend to get a little worried about the liquidity in the corporate bond market. You've been talking about it over the last couple of minutes quite extensively. The other question I had, Nipa, was that how do we address this problem of the pricing of non-sovereign debt? Because in any country, if you need to price corporate debt, non-sovereign debt, you need a yield curve. That's a well-developed yield curve that is across all tenors and all maturities. Like, unfortunately, what happens in India is that our entire GSEC market seems to be sort of stuck in that 7 to 10-year kind of tenor, where you have reasonable price discovery happening on the government yield curve. And beyond that, you have very distorted credit spreads. So how do we tackle that problem if I were an investor in this bond market?
So I think what we have seen in last 2-3 years, a very steep yield curve, which we hadn't seen for a very long time, which has allowed the short term of the yield also to be priced well. So you have a deep curve which is 2 to 5 year, and then 5 to 10 year. Fortunately, our insurance and pensions are becoming reasonably big. So today Indian pension funds are as big as most of their international counterparts, and they do invest almost 25 to 40% in government security. So if you see last few years, we have seen a 10 to 40-year curve also being established, and they may not be a big trader on a daily basis, but they are investors. And since the auction comes every week,
Right.
I think a reasonable amount of change we have seen, that we do see a 1 year to a 40-year price, which was totally absent earlier. There is also the stripping, which allows a zero yield curve to establish, also took place. And in any, again, steep curve, those markets thrive. So we have seen insurance company very heartily
The swap market,
participating
yeah.
in those markets. So somewhere, may not be crazy volume, but we have seen a reasonable change in terms of tenure and in terms of transparency and in terms of volume. So once that is done, then obviously comes the non-sovereign market. What we've seen is, of course, it's a different world for last 3 years, right? After COVID, we've seen war. The spreads have been unprecedented. And there are times within a same window bracket, like a double A, can trade with 150 bips difference. And I personally feel that it's a lot to do with what liquidity that provides and some of the perceived risk. I think both get priced in that very, very well. So, if you see a largely traded issue, obviously the pricing gets better, because many more participants are there. And, there would be a double A, but people don't perceive it the same as the other double A, or maybe an upgrade story. The yields could be higher.
So, as an extension of this question, I just wanted to ask you that the AAA bond yields tend to move in tandem with the repo rate. So, when repo rates move up or move down, the AAA bonds sort of reflect that. But as you rightly said, that doesn't happen in the low rated bonds. So, what are those factors other than monetary policy that impact the yields of these lower rated bonds? Like you said perception, but what are those factors that
Industry risk. So, like if you see microfinance industry, which did go through, a good amount of write-offs, you saw the yields raising. The good part of, at the yield, there was money available on bonds as well as for equity, for the balance sheets to be cleaned up again. So the perception of
these are sector specific risks?
it gets very sector or a company specific in terms of risk. Like we saw real estate at a very high yield, because one, there was no accessibility to banking finance for those people. At the same time, the risk perceived was much higher 5 years back. Today, if you see the real estate bonds, which will be probably supported by actual constructions and buyers, the yields could differ. So, I mean, infrastructure for a reason. We saw the airports in COVID times raising funds on mid-teens. But then we saw institutions like NAFID, IIFCL, NIIF come in. And we have seen infrastructure yields on airport roads drop by 350 bips. So, who are the market participant is important, industry risk is important.
So let me sort of move into asking you a couple of questions on the retail investor, because that's one segment that we find absent in the corporate bond market. And most retail investors have preferred traditional investments for obvious reasons, right? And in spite of the fact that markets have become more accessible to them, because we were talking about OBPP and how there are platforms, digital platforms that are available for them to access, most of them still don't understand the risks and benefits of investing in the corporate bond market. So, I mean, they may not understand what duration means, they may not understand what yield to maturity means, let alone what things like convexity, etc., mean, because that will be way beyond, their understanding. So, how do we improve the, financial literacy for retail participants? You did tell me that lot of these platforms have websites which provide information, but just by providing information they don't become wiser. So how do we go about doing that?
I think there is a time has come probably to have that awareness in terms of what debt instrument can do. As we all know,
So what can it do? Can you tell me that?
we say that compounding is the eighth wonder of the world. So when you look at your equity portfolios and a debt market which has given you more than 10% return year on year, at the end of 10 years they can be significantly similar. Equities have always been darling of Indian debt markets, of course, speculation, wealth
Indian
creation,
retail investors.
Indian retail
Right.
investors, because there is of course a hope of multiplying your money.
Correct.
Also the accessibility,
So one is steady compounding.
steady
Can
compound.
give you very similar kind of outcomes like investing into an equity mutual fund or an equity directly. Okay.
Totally. And I think that benefits need to know. I think there could be we have had a great education round for equity and mutual funds countrywide. Now that interest has gone up, now that there is an ability to give that platform and cater to that world, I think it's very important that
What about lower risk? I mean, is that something that we could get investors to understand?
absolutely very, very important. And it can help to put a lot of channelization of savings into this path.
So, on the same sort of argument which you had, uh, why is it that debt mutual funds have not sort of stepped in to this gap? Because, it is difficult for retail investors to understand the corporate bond market. But you have an instrument like a debt mutual fund, because if you look at the, 10.5 lakh crores of debt mutual fund AUM, less than 50% is retail. Nearly all of it is, I mean, 50% of it is institutional money, right? So how is it that, or why is it that the debt mutual funds haven't stepped into this space and, try to, educate the retail investor?
So two things. One, of course, something which can help debt market, either direct or mutual fund, of course, has been the tax part. And one is not really questioning about why higher tax, but you see every other instrument, whether you're talking about equity, whether you're talking about REIT and InvIT, whether we're talking about even a real estate which people can buy, today has a far better tax advantage, and the difference is just too wide. Even if I'm taking a real estate for 3 years, I am far better off a rental instrument than buying a bond.
Right.
And
Or buying a bond fund.
buying a bond fund or direct bond, because even direct bond is getting taxed at highest marginal tax, whereas all other savings is incentivized to be saved. So I think the difference can certainly come down. Mutual fund, of course, had a one piece where they had to step back because they had a tax advantage which went, whereas the other funds have the advantage. So that is the one very important. Second, I think it's a pool of investments, which apart from liquid and overnight, it's a view. So if my time horizon does not match with the fund, my returns can go quite up and down depending on the market movements, where those investors may be better off coming to a direct debt where they can have a defined return on the overall scheme of things. So I think what debt mutual fund provides great is the liquidity. And I think apart from few corporates at this point of time, and because again they are at a short end of the curve, the returns are limited. So you can see that a lot of them are now changing into the credit fund or private credit where the AUMs are rising, where people have started investing money. more from a yield perspective than a liquidity management.
Okay. So, passives have made a very big impact in, equity. So now there are, literally a large amount of new money that's coming into equity mutual funds are coming into passives. The total passive AUM in the bond market is something like 2 lakh crores. I think about 50% of them would be corporate bonds, 50% of them would be GSECs and SDAs, etc. So could passives be a alternative uh, to actively managed debt funds for retail investors?
I think big investors, especially pension and all, will probably have to align to that, methodology for that to become a reasonably big fund.
Okay. Because you have, like, for example, the Bharat Bond Fund, etc., which is giving you exposure to fairly large spectrum of the corporate bond market today, isn't it?
Yes, absolutely. But what happens, the larger investors are able to do it themselves. The variety as well as, the mix. So the ability to have a larger corpus, and then which can be followed by retail is slightly less.
Right. So thank you so much, Nipa, for this conversation. It has really been fascinating, and I think we've taken a lot of insights on the corporate bond market from you today.
And thank you so much. Really appreciate it. It was lovely talking to you and look forward to learning more and more from you.
Sure. Thank you.